Assalamu alaikum, second year commerce. How are you? We were revising the chapter number 4. Today we are going to revise a topic from chapter 4 Central Bank, and that is methods of credit control. There is another name for this credit control method, which is instruments of monetary policy. So never get confused between these two. Methods of credit control and instruments of monetary policy both are same thing. So what are the method of credit control? Now look over here. As we discussed in the last revision classes, what is monetary policy? These are the steps of controlling credit and money supply in the country. And in the last revision class, we discussed the objectives of monetary policy. Remember those 12 objectives of monetary policy? It is the instruments of monetary policy or methods of credit control. So what instruments does State Bank has to control credit in the country? State Bank has two instruments. One is quantitative and second is qualitative. Credit control methods are classified into two. The first method which State Bank uses to minimizes or increase of credit are called quantitative methods. And similarly, there are other methods to control credit in the country are the qualitative. Okay, quantitative and qualitative. Quantitative deals with numbers, while qualitative deals with description. Quantitative methods, their central bank is doing some changes, maybe in rate, and in qualitative method, central bank is directing all banks by just writing or passing descriptions to them. Quantitative deals with numbers and qualitative deals with descriptive measures. Okay, now quantitative methods. There are four quantitative methods which are the physical methods which deals in changing some numbers up or maybe down. So the first is changes in bank rate policy, which is also called rediscount rate policy. And guys, this rediscount rate policy is a very important short question for 2020 board exam. Similarly, the second is open market operation, OMO. Again, it is a very important short question for FBISC 2020 exams. Third method, which is quantitative, is changes in reserve ratio. And the last is credit rationing. The rationing means restrictions. So we will see one by one into detail. Today we are just going to discuss the first method, that is changes in bank rate policy or rediscount. Inshallah, in the next revision class, I will discuss all three remaining. Quantitative are physical methods. Quantitative deals with numbers. So what is this bank rate policy or rate discount? Look, what is a special, before going into the topic, we need to clear what is bank rate. Bank rate is a rate which is between central bank and commercial bank, is known as bank rate. There is one more name for this rate, and that is rediscount rate. I am repeating it. The rate when commercial bank takes loan from the central bank, the rate which is between commercial bank and central bank is called bank rate or rediscount rate. So in Pakistan, usually it is 10%. Now, what central bank is doing in controlling credit to this bank rate? Please keep in your mind that this is one of the tactics of monetary policy to control credit. Credit means loaning in the country, okay, or supply of money in the country. If there is inflation in the country, how central bank will control inflation with this first method? If there is a deflation in the country, how central bank will control that deflation by using this method? Now look over here. When central bank increases this bank rate or rediscount rate, then commercial bank also increases their interest rate. What is this interest rate? Guys, this interest rate is between commercial bank and borrower. So the rate which is between central bank and commercial bank is bank rate. The rate between commercial banks and borrowers are called interest rate. For example, if I will go to any commercial bank and I will ask commercial bank to give me a loan, they will charge me interest rate. Okay, when commercial bank will go to central bank and ask central bank to give them loan, they will charge them bank rate. So when central bank will increase rediscount rate, simultaneously commercial bank will also increase their interest rate. So what will be the result? Look, if interest rate will be increased, people will be reluctant to take the loan from the commercial banks because now loans are expensive because of the rate of interest is higher. Borrowing will be decreased and credit will contract. Overall in the country, businessmen will less take the loans. When they will take loan less, they will supply less and prices in the market will come down and prices will decrease and inflation can be controlled. So this way, by just increase the interest rate, central bank will decrease inflation in the country. So guys, I always recommend one shortcut to remember this thing. And what is it? Look, what is objective of central bank? Objective is to control inflation in the country. To control inflation in the country, what central bank will do? Central bank will increase bank rate. And what will the result? Result will credit contraction. How you remember? Always remember this I in increase and inflation I and increase I. So whenever there is a inflation in the country, an objective of central bank to control inflation, central bank will increase bank rate and in this way credit will contract, prices in the country prices in the country will come down due to less supply from the businessmen. Okay, come back to the slide. On the other hand, when a country is facing deflation, again deflation is a situation where prices are very low in the market, but because of unemployment there is no jobs in the market, people are facing problem to buy goods from the market. To remove this deflation, what strategy central bank will adopt? Central bank now decrease the bank rate or rediscount rate. If central bank will decrease this, simultaneously commercial bank will also decrease their interest rate. Any borrower will find any loan cheaper. What they will do, they will go more for bank loan and credit will expand. When credit will expand, more employment opportunities in the country, more investment, more production will generate and prices level will increase and deflation can be controlled. So guys, how to remember over here when there is a deflation in the country? We know that both situations are bad for any country. So deflation, what central bank will do? Decrease. Central bank will decrease bank rate. By decreasing the bank rate, credit will expand. Borrower will take loan more and prices will go up and because of more supplies by the businessmen in the country. So guys, how to remember this? This is a shortcut again. Remember this D, deflation D and decrease bank rate D. So whenever there is a deflation and government wants to control this deflation, central bank will decrease the bank rate. So simultaneously commercial bank will decrease their interest rate and credit will expand. Okay, so I hope you understand all about the first heading, that is changes in bank rate. policy. Hope you understand, guys. Any ambiguity you have, please do write in the comment section. Inshallah, I will reply you. Take care.